Well, good afternoon, everyone. I guess we'll get started. This is Frank Bridges. This is the third of our series of SDRAFocus webinars, and it is being recorded so that we'll be able to give a link to the webinar that will be it'll end up at YouTube, and you'll have a link if you can't make it. Actually, everybody who can make it or can't make it is going to have a link to the webinar, and so they can watch anytime they want to. Well, we've had a very interesting case come up in September from the tax court that brings up a whole lot of issues that are very relevant to self-directed retirement account owners. And so I thought it would be a good time for us to discuss the case. I actually spoke to the person who runs the equities department in Pensko yesterday, and they weren't even aware that the case had been decided yet. So this is brand new, and it was decided in September. So let's talk about this case. The case is Ellis versus Commissioner, and what the case is really about is a couple of things that are near and dear to my heart. One of them is called the simultaneous funding rule, or theory, and the other one is the theory that an IRA in many cases cannot add extra equity investment into an entity even though it's an investor, called the no follow-on investor rule. And that's kind of a handicap for a lot of people, because when an IRA or an IRA with disqualified people own 50% or more of an entity, that's when the rule applies, so that you can't put more money in. And that's kind of gotten a lot of people into some difficulties. So, so here's the issues. The first is a very old one. When is an entity a disqualified person? In particular, when is a corporation or an LLC a disqualified person? And is an entity that is owned by an IRA a disqualified person? And is simultaneous funding a valid theory? And is no follow-on investment a valid theory? So what's simultaneous funding? Simultaneous funding is the idea that if the IRA, together with IRA owners, are going to own 50% or more of an entity that's being started, and if there are also disqualified people who are making contributions of capital to the entity, everybody who is a disqualified person with the retirement account has to put their money or their investment into the entity at the same time. Everybody has to invest simultaneously. That theory came from a case called the Swanson case, which we'll be discussing today. And of course, the corollary to that is that if the retirement account has to invest simultaneously with everybody else, and the entity becomes a disqualified person with respect to the retirement account because of the ownership issue, then the retirement account can't make any more contributions to the investment in the entity. So I'll talk a little bit about how that came about. And if you've just come on, I would ask that you silence or mute your mic or your telephone so that feedback doesn't come through to everybody, because that we end up getting feedback. If you want to break in or ask questions, feel free to unmute your telephone or your mic and just break in, interrupt me. I'd love to have an interplay of questions and answers while we're going along. So, here are the fundamental key precedents. There's Internal Revenue Code section 4975 E2G, and what that is the subparagraph of the definitions of who is a disqualified person that talks about entities. So any entity that's owned 50% or more by disqualified persons is a disqualified person with respect to a plan or a retirement account. The disqualified person is any fiduciary of the plan or the retirement account, and their family members, along with entities that are owned 50% or more by them. And then an entity is either a corporation, a partnership, or a trust, or an estate. Now the trust or estate has to be 50% or more for the benefit of a disqualified person. And so if you have an IRA, of course, and you're the owner of the IRA, it's 100% for your benefit. So it theoretically fits the definition of a disqualified person in and of itself. So the question is an IRA a trust greater than 50% or more for the benefit of its owner? Since the owner has the ability to make decisions on investments, that makes the owner a fiduciary of the retirement account and puts the owner right into the definition of disqualified person. Note also that a beneficiary purely on the basis of them being a beneficiary is not a disqualified person unless they are a fiduciary of the retirement account. So theoretically you could have someone else be in control of the investment of your retirement account and have no control over that yourself, and in that case you would not be a fiduciary of the plan, you'd just be its beneficiary. So here's the Swanson case. This is where the Ellis case really comes from. So in Mr. Swanson's case, he had an IRA. I think it came from his 401k from one of his businesses. And he took the IRA and he purchased stock in Swanson Worldwide, Inc., 2,500 shares. The IRA ended up being the only owner. And, the diagram here is a little bit off. It should say shares of stock, 100% at the bottom there. But the IRA owned 100% of all the shares of Swanson Worldwide. Now, the interesting thing was that Swanson Worldwide was a domestic international sales corporation, and it was established by Mr. Swanson so that it could get commissions on the sales of shipments that went overseas from his other companies. I've always wondered why IRS didn't look at that as a potential disqualified prohibited transaction, but it never did, apparently. So, but Mr. Swanson was the sole director, president, treasurer, and clerk of Swanson Worldwide when the IRA purchased these shares, the 2,500 shares. So IRS said, gee, the entity is a disqualified person because Mr. Swanson has so much participation in it individually, and therefore the purchase of the shares was a prohibited transaction. The purchase of the shares by the IRA was a prohibited transaction. But the tax court really disagreed. What they said was that before the purchase of shares, the entity could not be a disqualified person because it has no shareholders. Remember, the definition of a disqualified person that's a corporation has to have 50% or more of its shares held by one or more disqualified people or persons in order for it to be a disqualified person itself, from the point of view of the shareholders. So I'm getting a message, if you don't mind, folks. I'm getting a message that my audio is being degraded, and it's asking me to close out any unused internet applications. So I'm going to just take a minute to do that. Oh, I don't have Explorer open, so just give me a second to close it now. Sorry for the interruption. Okay, would somebody just unmute themselves and tell me whether the voice quality of the recording is okay? Can you all hear me all right?
Yeah, it sounds fine to me.
Okay. All right, so getting back
to... there was never any degradation on my end.
All right, great. All right, so here we are with Mr. Swanson, and the court says, no, since the Swanson Worldwide had no shareholders, it couldn't possibly be a disqualified person with respect to Mr. Swanson's IRA, so the IRA's purchase of the shares was not a disqualified person. Was not a prohibited transaction. And they felt so strongly about that, and they felt that IRS's argument was so silly that they required IRS to pay Mr. Swanson's legal fees in connection with the dispute. But there was one aspect of it that has been often commented on and has become a problem for a lot of self-directed retirement account owners, and that is that in a footnote, the court said, and this was not necessary for the decision, it's what we call dicta or dictum, a dictum in the legal world. They said that after the purchase of more than 50% of the shares by the IRA, the entity, meaning Swanson Worldwide, was a disqualified person. Why did they say that? Well, they said that since the IRA, since Mr. Swanson was a fiduciary of his IRA, he was in control of its investment because it was self-directed. Since he was a fiduciary of his IRA, the IRA was 100% for his benefit, and therefore the corporation was beneficially owned by him, and therefore the corporation was a disqualified person as soon as his IRA owned 50% or more. Now again, that footnote was not necessary to the decision, but they said it anyway. Some bright clerk probably thought it was a great idea. But the main conclusion of Swanson was, before a corporation has shareholders, it is not owned 50% or more by anybody, so it can't be a disqualified person. And that's the reason why many practitioners say, all right, if we're going to have a corporation that is going to be owned, or an entity that is going to be owned 50% or more by retirement accounts and disqualified persons, they all have to put the money in at the same time. Of course, that never came, that idea was never a product of Swanson. Swanson actually was a case where the IRA owned 100% of the corporation, not some other percentage. So there was no mixed shareholder ownership of Swanson, of the Swanson Corporation. So more conclusions of that were, though, that for the purposes of Section 4975 E2G, which is the entity definition for disqualified persons, an IRA is a trust for the benefit of a disqualified person if the owner controls its investment. And because of that, if an IRA owns an entity greater than 50%, the entity is a disqualified person with respect to the IRA. And to that, my comment is, huh? Because if you think about it, it really doesn't make any sense. If your IRA makes an investment in an entity like an LLC, and it owns 100% of it, and then it goes out and buys another piece of property or a piece of property, and then it needs to make additional investment in order to maintain the property, what the Swanson case footnote says is you can't do that. There's no follow-on investment. Now, the Labor Department, which is in control or under the statute and an agreement within the U.S. government, is in control of advanced interpretations of Section 4975, has often said that when an IRA or when a plan owns 100% or even a percent greater than 50% of an entity, it can still make contributions to the entity. So the Labor Department's interpretations are directly contrary to what the tax court has said in this footnote. And frankly, in my opinion, the Labor Department's interpretations are clearly more intelligent than the tax court's idea that suddenly the entity becomes a disqualified person. The real reason why I disagree with this whole theory is that, in fact, an IRA is not in the terms of, in the normal business terms of, or in the normal terms of what a trust is, it's not a trust. A trust typically has a separation between the ownership of the assets by the trustee and the benefit of the assets for the beneficiary. So traditionally, you had to have separation of legal title from beneficial ownership in order for there to be a true trust. In more recent years, there have been statutes passed to allow revocable living trusts so that you can have your own revocable living trust and be its primary beneficiary and not have the trust merge, so to speak, or disappear. But traditionally, the law has always been that if the same person was both the trustee and the beneficiary of a trust, there was in fact no trust. The whole idea of the trust merged into a single identity, which was the individual. So in the IRA case, there isn't any difference between the person who's in control of its investment, although of course there is a custodian, and the beneficiary. The custodian is really just a placeholder and is completely in control of, is completely not in control of how the assets or how the money of the IRA is invested. Massachusetts has an entity called a nominee trust, under which the trustees, although they are trustees, the document specifically says they have no power to manage the assets without the direction of the beneficiaries. And in Massachusetts, and also for federal tax purposes, those trusts are ignored for tax purposes. You don't file it, you don't get a tax ID number for those kinds of trusts, you don't, and you don't file income tax returns or any kind of returns for a nominee trust, because the ownership of the trust and the control of the trust by the beneficiary says that it's not a true trust. So if you're looking at a retirement account, an individual retirement account, it just doesn't make sense for it to be considered a true trust. So that's one of the reasons why I think the whole idea that an IRA is a trust for purposes of Section 4975 doesn't make sense. So the practical conclusion then was when you fund an entity with IRA funds in the IRA and other disqualified, and if it's the IRA and other disqualified persons as well, will own 50% or more, you have to make all the investments at the same time, simultaneously. That's the simultaneous investment rule, and that once the entity is owned 50% or more by an IRA and or other disqualified persons, it can't contribute, the IRA can't contribute more money to the investments. So along comes the Ellis case. Now here's what Mr. Ellis did. He had a 401k, and he transferred it to an IRA, a self-directed IRA that he created. Now there's an interesting set of timing factors here. In May of 2005, he had his attorneys establish an LLC called CST LLC. And the operating agreement for the LLC said that the owners of the LLC would be the retirement account and one other person who was going to own 2%. Except the retirement account, the self-directed retirement account, had not been established yet. So what happened was Mr. Ellis, purportedly on behalf of his retirement account, which had not been established yet, signed the operating agreement in order to establish CST. So the normal process of actually establishing the IRA first and then funding it with funds into an LLC that's established second wasn't followed in this case. It all occurred in 2005. So the total amount that Mr. Ellis had in his 401k was $321,345.25. And so what he did was he actually transferred that from his 401k over to his IRA in two different installments. The first one came in an installment of $254,000 on June 23rd, 2005, or a little bit before that. And the second one came a little bit before August 23rd, 2005. So what he did was he took the first $254,000 on June 25th and purchased units in the LLC. In other words, he made that initial investment contribution of $254,000. Then, 2 months later, he added another $65,500, so the total of his investment was $319,000. I think if my addition is correct, $319,500. And with that total $319,500, he purchased 998,000 units of the LLC. The other 2,000 units were held by a third party who was unrelated to Mr. Ellis. Now, I'm sure that some of you may find that familiar, because although many LLCs that are established for IRAs are called single-member LLCs, there are other ones that are established with very small minority positions in them, like 1 or 2%. And the purpose of that the argument has been, that once the entity is not owned 100% by the retirement account, it can be what's called an operating company. An operating company is any company that sells products or services to the public, other than financial instruments. So as long as you're not owned 100%, you can be an operating company. The purpose of being an operating company is so that the assets inside the LLC, under Labor Department regulations, are not considered IRA or plan assets. So in this case, what Mr. Ellis was doing was establishing an LLC, purchasing LLC units with his IRA, and making the LLC, he thought, into an operating company so that the assets of the LLC were not IRA assets. And if they're not IRA assets, then Mr. Ellis can have transactions with the LLC himself, and since he's not having transactions involving IRA assets, then it can't be a prohibited transaction. At least that was his theory. But note here, what we have is 2 separate contributions to the LLC. It's not 100% owned by the IRA, and this is not simultaneous funding. So here's what IRS said. The LLC, this is an LLC, not a corporation, and the Swanson case said that Swanson case was a corporation, and so the Swanson case doesn't apply. Now, that's an interesting argument, but really nobody ever thought that that would be an argument that the court would follow. And then they said, after June 23rd, 2005, CST was a disqualified person with respect to Ellis's IRA, and the sale or exchange of assets of units to the IRA after June 23rd was a prohibited transaction. All right. So in other words, IRS is basing its entire case on the theory that simultaneous investment is correct. All the money had to go in at once. Otherwise, once some of the money went in, the LLC was a disqualified person. So let's see what the court said. The court said first, the type of the entity doesn't matter, whether it's an LLC or a C Corp. It just didn't matter. And what they said was that the initial capital contribution of the IRA was $319,500, and that was affected, that's the words the courts used, through the transfer of funds to CST in 2 payments. So what they did was they said, okay, well, the LLC has an operating agreement that says the IRA is contributing $319,500 in exchange for 998,000 units. And so just because the money came in 2 different payments doesn't make that anything other than the initial capital contribution from the IRA. So the practical conclusion was then, when you fund an entity with the IRA funds and the IRA will own 50% or more, you don't have to make all the investments simultaneously. You can do it in installments, okay? And you can do that provided that it's an initial investment. Now, the court didn't actually say that this only applied to initial investments, but so far, if we're going to read the case narrowly, we would have to say it applies to initial investments. But think about it. It's not unusual for a company, an LLC, to be formed for the purpose of in purchasing more than one property, maybe multiple properties, 2 or 3. And so you form the LLC and then you start looking for the property. That's fairly common. You might find one and now you need the money to purchase it. So the money from the IRA comes in for the deposit, and then when you close, the rest of the money to purchase that property comes in as well. But then you need more money later on when you find the second property or the third property, and you go through the same exercise. Under the Ellis case, one could argue that if the initial operating agreement says that the total amount that's going to be contributed by the IRA is, let's say, $1 million, and the plan is that you're going to buy all 3 properties for less than $1 million, or you might even buy them with some debt financing if you're okay with the debt financed income. If you're going to if the total amount that's being contributed is $1 million and it says so in the operating agreement at the beginning, that's what the contribution is, Ellis would suggest that you haven't made your initial equity investment until you're finished with making the investment for the third property over whatever period of time that might be. That could be a year, could be 2 years. Theoretically, one could argue the Ellis case allows you to do that, whereas the simultaneous investment theory along with the no follow-on investment theory says you can't. So this is quite different. The other practical interpretation, if we're looking at this restrictively, although you don't have to make the initial investment simultaneously, once the IRA makes its initial investment, it can't invest anymore. That would be the general interpretation of the Ellis case's theories. Now, understand that is not what the court held. What the court held was that by making two payments for his initial investment, Mr. Ellis did not commit a prohibited transaction on the theory that the entity was, once his first contribution went in, on the theory that at that point the entity was a disqualified person. They didn't actually go beyond that point and say, but, and although they quoted the Swanson case, they didn't go on to say, but as soon as all those payments were made for the initial contribution, the entity was a disqualified person. One could certainly infer that from the way the issues were approached and the way the court stated the principles, but it didn't actually hold that. So, again, my answer to that, my incredulous response to that is, huh? If an entity is owned 100% by an IRA and it owns several properties, and all of a sudden, let's say that there's some kind of a disaster, there's a tornado or whatever it may be, and repairing the property calls for adding more investment in, and you've got it, there shouldn't be any reason why the IRA shouldn't be able to do that. It doesn't make any sense. And as a matter of fact, the inability to make additional investment in the entity could jeopardize the value of the investment for the IRA. And actually the Labor Department has said that several times in its advisory opinions. The problem is that the advisory opinions of the Labor Department are not binding court cases, and so they are only binding with respect to the person for whom they issued the advisory opinion. So you can ask for an advisory opinion, they can issue you an advisory opinion, and that's enforceable against IRS, but nobody else can rely on it. It's sort of like a private letter ruling for IRS, but IRS doesn't do private letter rulings in this area. So you have to rely on the Labor Department's advisory opinions to sort of get an idea of the way the Labor Department says it, and then hope that eventually the tax court gets it and understands that this is a little bit ridiculous. Because if you think about it, if the entity is a disqualified person with respect to the retirement account, that means that there can be no exchange of property between the disqualified person and the retirement account. So how is the retirement account supposed to get its return? How is it supposed to get distributions from the LLC? how is it supposed to, if the LLC sells all of its assets and wants to liquidate, how are the proceeds of the liquidation supposed to get to the IRA? That would be theoretically a prohibited transaction, and that doesn't work. So it really is a little bit nonsensical for this whole theory to be controlling, or at least the guiding light of what the tax court is saying. So here's the second part of the Ellis case. So we've got the CST, and Mr. Ellis has not committed a prohibited transaction. And of course, you know what IRS is after. What they'd like to do is disqualify Mr. Ellis's IRA so that he owes taxes. And oh, by the way, all of this comes up in 2011. He formed the entity in 2005, operated it in 2006 and years thereafter, and all of a sudden in 2011, IRS audits his return and says, oh, we're going to assess you a deficiency because we think your retirement account was disqualified, and that whole $323,000 was distributed to you effective as of January 1st, 2005. Think about it. And by the way, we're in 2013 now. That's 8 years later. Okay, so Mr. Ellis then, by the way, CST was an automobile dealership. They sold used cars, and Mr. Ellis became the general manager. And so Mr. Ellis paid himself the sum of $9,754 in 2005 and $29,262 in 2006. So IRS says Mr. Ellis argued that he was paid from operating company funds, not IRA funds. The company funds were not planned assets, and therefore there was no prohibited transaction. IRS disagreed. IRS said, no. You've got to ignore the entity in the middle. Mr. Ellis had the plan to pay himself with his own retirement account assets, and that doesn't make any sense. Notice the distinction between being the general manager of the LLC and managing the people in the LLC and being paid for it, and being a fiduciary. If Mr. Ellis acted purely in his fiduciary capacity, what he would have done would be to hire a general manager and hire everybody else, or have the general manager hire everybody else, and just make decisions about who did what or who got hired like a fiduciary, keeping his participation minimal so that the operation of the IRA and the investment of its assets could be monitored by the fiduciary. So what happened next was the court said, no, Mr. Ellis used his IRA to establish a business that was to be his primary source of income. And his role as general manager was not for administration of his IRA or for management of its investments. Okay? Remember, when we're establishing a single-member LLC and the retirement account owner is the manager, it's okay for the manager to do things like what's necessary for the administration of the IRA and for the management of its investments, but nothing more. So since Mr. Ellis was operating it as the general manager and not as a fiduciary, he had disqualified his account as of January 1st, 2005. Okay? The compensation in 2006 was fine because by then the IRA was not an IRA anymore. It was his money. So, but furthermore, here's what the court is saying. Mr. Ellis owed income tax on the $321,345.25 in 2005 as a distribution. Mr. Ellis was under 59.5, so he owed a penalty tax of 10% for 2005. So that's another, beyond the 28% or whatever it might have been in 2005 for the federal tax, he owes another 10%, $32,135, I guess, as his premature distribution tax, because he's under 59.5, and also he underreported his income in 2005 by more than 20%. In other words, you're supposed to report at least 80%, or you end up with an underreporting penalty. So Mr. Ellis owed an underreporting income tax penalty because he reported less than 80% of his actual income, and so he had that penalty. And oh, by the way, he owes interest on all of that, on the unreported taxes, from 2006 through 2013. Okay, because he should have reported it on April 15th, 2006. So starting in 2006, for that 7-year period, 7.5 years actually, he owes interest on the taxes. A disaster for Mr. Ellis, I would say.
I have a question, Frank.
Yep, go ahead. Who's this?
This is Dave Ciappone.
Hi, Dave.
So, hi. How did the IRS ever pick up on this?
You know, I don't know. I suspect that Mr. Ellis just got audited. It could have been an arbitrary situation, or maybe they were auditing his automobile dealership. Okay, because that happens periodically. So they probably audited his automobile deallership, found out who the owner was, and started looking at that. Because
they would not have audited. Typically, they don't audit multi-member or single-member LLCs that are pass-through entities, right?
That's right. But they might be. But they would audit businesses. Okay.
Right.
And they might. And since he's reporting income from a business, from that business that he's the general manager of, and I think sometimes they target particular industries. So he may have ended up in the middle of their search for used car dealerships and to see if they could audit those. But there's nothing in the case that says how or why the audit occurred. But it was definitely an audit of Mr. Ellis.
Right. Okay. And how many people are fouling this up with? I can imagine that there must be a lot more Mr. Ellises out there.
Well, you hit the nail on the head. This is the primary concern of most self-directed retirement account custodians, and one of the reasons why they don't allow, or many of them do not allow, retirement accounts to be majority or 100% owners of LLCs. You know, the whole idea of the so-called checkbook LLC is exactly what Mr. Ellis did, okay?
Mm-hmm.
And so there are a lot of custodians out there who simply will refuse to make the investment when they realize that it's going into an LLC that they're going to, as custodian, own more than 50% of, or 50% or more. Right. Pensco made the decision, and actually I think it was 2008, that the way they were going to get around that was to require everybody who was doing that, and they call it a family-owned LLC, whether it's single member or not, require them to have the whole special advisor thing, and that's why they will do it. The reason that they, and some of you have told this, but the reason that they're concerned about this is because they're a bank. And IRS has gotten together with the bank examiners and said, you know, if you find a self-directed retirement account that is a potential for abuse, it's a risky asset. And when banks hold risky assets, what happens? The banking examiners say you've got to come up with more capital because your asset base may be too low for what you're doing. And so when Pensco gets examined on a regular basis by it's actually a New Hampshire bank, by New Hampshire bank examiners, they want to make sure that all of their files are put together in a way that the bank examiners will pass over them and say, okay, this is not so risky. And that's the advisor mechanism that they have. Okay. So I'm getting another thing that says it's overloaded.
Yes, you're breaking it.
So I'm going to say yes, turn my webcam off. So can everybody hear me all right?
Yep.
All right. So any more questions? We're pretty much at the end of this anyway, so are there any more questions? All right, so really the implication of this, and thank you all for coming, the real implication of this is that the law is progressing, and we have to watch the law and make sure that we understand it. But now it appears that the traditional method of funding LLCs with initial investments over time, sort of on a call basis by the entity, is okay as long as the amount of the investment is initially subscribed for. I don't know if everybody will interpret it that way. When I spoke to the people at Pensco, they were unaware of the case, but certainly we're going to download a copy of it and read it, so we'll find out what they think. But from that point of view, it's something of a liberalization of the rules. So even though the tax court still thinks us for the benefit of a disqualified person, and therefore the entity that it owns is a disqualified person, and that's a little silly, we still have a bit of a liberalization of the whole idea of how we can actually fund LLCs. So simultaneous investment may not be so much of a bugaboo anymore. But remember, the whole idea of simultaneous investment and no follow-on investment theories, these are rules that the custodians call for so that they can protect themselves and protect the accounts from allegations that they're disqualified. They're not actually rules that are decided by IRS or the courts. As a matter of fact, the Labor Department seems to be making decisions completely contrary to that. But unfortunately, we're bound by the cases of the courts, and as long as there's a decision out there that says that an IRA can be a disqualified person with respect to itself, which is what the Swanson and Ellis cases say, in my words, to be conservative, we have to follow the rules conservatively and follow what they suggest we can do. So, that's the whole implication here, is we just have to keep watching to make sure we're staying ahead of all of this, and at some point, hopefully this will be resolved in our favor. All right, any other questions?
Yeah, Frank?
Yeah.
Can you hear me?
Yes, I can.
Okay, it's Frank Noe. How you doing?
Good. How are you, Frank?
The question I have is, if the IRA was to purchase land, and then that land would be used to develop, let's say, a building, at a later point, whatever, a year later, a year and a half later, is that considered a simultaneous investment?
Well, if you knew up front the total amount that the IRA was going to put in, theoretically you could have the operating agreement say that the IRA was subscribing for the total amount, and then the various different payments could come in over time, so as you develop the property. If you bought the property and didn't know what you were going to do with it, so your IRA, your operating agreement says that you're only going to put in the amount that was necessary to buy the property, that would be different. In that case, probably what I would do.
What happens if there's a shortfall or an overage in that calculation or that number that you think you're going to use for the construction end of it?
Well, you've got your finger on the big problem of this whole theory that you can't follow on invest with your own retirement account. Okay? That's why it's important to be very conservative in your estimates of how much money is going to be necessary, or have an arrangement where you know you're going to get the money from somewhere else. You might set it up so that even though they might be disqualified persons, they might have a different class of units, and those might be accessible, whereas the IRA units might not be accessible. And then just divide up how the profits are divided up based on the initial operating agreements. So, your non-accessible units get a certain percentage of the profits, maybe they're preferred units, and the accessible units get a different percentage or a percentage on another basis. It's not unusual to divide it up that way.
And then would you need a third party to administrate the construction end of that project?
You would definitely need to hire the third party. You couldn't. The owner of the account, if they have a majority interest account money, couldn't work for the entity. There's some. All right. Well, I'm sorry. Maybe you should give me a call a little bit later, because I'm happy to talk to you about that kind of question. Okay. Any other questions?
Thank you.
If anybody else has that same question, feel free to call me. All right. Well,
hey,
I think we're going to.
I have one more question, Frank. Oh, you're done?
Well, no, we got a couple more minutes. If you can hear me, let's go ahead.
I can hear you. So I have a 401k, an IRA investment in another limited liability company, not the one that you're acting for my father on and I'm the managing member of.
Mm-hmm.
But Pensco did allow me, through my IRA, to make follow-on investments up to 50% out of my IRA in that company when shares became available.
All right, but at that time,
So
did you own less than 50% when you started?
Yes.
Well, that's what from Pensco's point of view, therefore, the entity was not a disqualified person.
Got it. That's why they don't want me to go over 50%.
Or they don't want you to get to 50%. In other words, you could actually, if you had, let's say you had 40% now, you could put in enough money and actually own 60%. But at that point, the entity is a disqualified person. You can't put more in.
I see. Okay, then I'm safe on that one. I was a little bit nervous based on what I heard, but thank you very much for clarifying that.
All right. All right. Well, if there are no more, go ahead.
One final question for us managing members, and you're sending out these SDRAFocus webinars. Are these requirements for us, like ongoing education, or I know I've missed the first two, and I've really been wanting to make one. I just didn't know if these are formal requirements of mine. So my father's IRA investment in our family LLC is okay, or what is the because you described this entire webinar to me when we were making the investment.
Well, as far as Pensco is concerned, no, it's not a requirement. It's frankly, as far as I'm concerned, you're not required to attend. You're just just foolish not to. It's purely for education purposes, and the reason that we're recording them is that we know that not everybody can attend at the same time, so we're making it available otherwise.
Got it. So it's ongoing education.
That's it.
Thank you very much.
All right, everyone. Nice to talk to you all. Hope you enjoyed this and this was helpful. And have a good day, and actually have a very happy Thanksgiving Day, and I'll see you on the third Tuesday of December. So have a good day.